and welcome to Know Your Company, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. To start off with, today we are going to talk about Gulf Oil Lubricants. Now, clearly, if you see in terms of what the company does, what's interesting about the company is that they are into the business of manufacturing and selling auto as well as non-auto lubricants. Secondly, it's one of the 3 private lubricant companies in India, amongst the top 3 in fact. It operates in B2B as well as B2C segment. And in terms of the volumes, clearly they've grown nearly 2 to 3 times the industry over 2022 to 2024. Now, in terms of the product mix, let's quickly look at that part of the business. Diesel engine oil around 40%, personal mobility is around 20%, industrials is around 15%, and others around 25%. What's interesting over here is that India's lubricants industry is well poised for significant growth, with lubricant demand which is projected to rise by nearly 3% volumes over the next few years, and an even stronger 6% value growth in both consumer and B2B segments that are driven by premiumization. And this is coming in despite the global push for decarbonization. Taking all these parameters into consideration, let's quickly understand the rating parameters from here on that we will be rating Gulf Oil Lubricant at NDTV Profit. On number 1, with regards to the income statement check, what revenue, margins, and your profitability is telling you about the company. Balance sheet check in terms of, the debt profiles, return ratios, plus you have the cash flows. Moving on, you have the shareholding pattern, whether the promoters are selling or not. Is it the FIs, DIIs who are buying? Do they have interest in the company or not? The street credentials in terms of what the ratings are. Their dividend payment, whether they've improved their dividend payment policy to the investors or has it been stagnant from here on, and the street coverage. So these are the 8 parameters that NDTV Profit will be looking at with regards to Gulf Oil Lubricants. To start off with, let me also get in my colleague Mihika, who tracks this company pretty closely. Mihika, over to you.
Yeah, I'll start off with the income statement check. We're going to take the last 3 full financial years as well as the company's performance in the first 9 months of FY25. Now, if you look at, your revenues, FY24, a top line of 3,276 crore rupees. This is a 22% 3-year CAGR, and in terms of 9 months, well, it's 2,678, and that's a 10% year-on-year growth. Your EBITDA, 416 crores in FY24, which is a 21% CAGR, and 333 crores in the 9 months FY25, posting a 10% annual growth as well. And lastly, when you look at your bottom line, 304 crores in FY24, which posted a 20% 3-year compounded annual growth rate, and 9 months FY25 so far, the company has recorded 268 crores in the net profit, which is a 21% year-on-year growth. The company margins have declined 40 basis points if you look at FY22 to FY24, but in the 9 months FY25, they are at 12.4%. In the Q3, it's crossed 13%. This is well between the guided range of 12 to 14%, so it's a thumbs up on this one. And then you have a balance sheet check. This is as of the first half of FY24. You have your equity shareholder funds at, roughly around 1,400 odd crores. Borrowings are at 431 crores, but these are short-term borrowings, and the company's cash equivalents is at 844 crores, indicating that in case they have to pay out their borrowings, they do have the capacity to do so from their internal accruals. So it's a thumbs up on this one. But Hiral, I'll come to you for parameters like return ratios, cash flows, and shareholding. What is the picture there?
So with regards to return ratios, it's a pretty interesting picture, because from the data that we've pulled up so far, if you see from FY22 to 23, the return on equity has been improving. So overall, if you see from 22% in 22, it's gone to 21, but bounced back to a 25% in FY24. Similarly, the ROCE has moved from 24% to a 30%. Now, the last 3 years seem that there is good improvement, but what we need to note over here is, I was just looking at data between FY15 to FY18 and 19. In that period, the return on capital employed, that's the ROCE, was above 35 to 40%. going up to almost 67%, right? So they have been on that trajectory, taken a hit to come down to those 20s numbers from FY20 onwards. And now again, it seems they are on a gradual recovery path. So if this kind of recovery continues, it's an absolute positive that we could see in terms of where ROCE goes. So that's with regards to the return ratios. Now coming to the cash flow, the cash flows again, whether they will improve from here on or not is what we need to watch and see. But currently, FY24, they're sitting on around 52 crores. In the previous year, the net cash flow was around 61 crores. And in FY22 was around 57 odd crores. And if you see in terms of the cash flow from operations as well, negative in FY22, but a gradual improvement that's coming from 233 crores in FY23 to 341 crores in FY24. Now, what is this number really indicating? When you talk about the net cash flow as well, what's the kind of liquidity situation that the company has, right? There was a point in time, if you would look at FY20, you had a Gulf Oil Lubricant, which was really sitting on net cash flow as little almost over 250 odd crores. So whether they will be coming back to that number or not is what we need to wait and watch and see. But yes, they have made investments in the EV side of the business, because currently the company was absolutely a non-EV focused company, but taking into consideration the way the world is moving, their investments in EV is what probably is impacting the overall net cash flow position of the company as well. And the investments are going in the right direction. So that is going to be the key that we need to wait and watch and talk to the management about as well.
If you look at your, street credentials, well, in terms of your 5-year share performance, the stock is up 42%, but the 1-year share performance is at 7%. So when you look at, if you compare it to, the Nifty 50, the stock has outperformed the Nifty in the last 1 year, but it has underperformed the Nifty in the last 5. And this is why we're giving this parameter a neutral for Gulf Oil. You have seen gains, but we've compared it to the benchmark and how it's performed, with respect to that. In terms of dividends, however, it is a good picture. Dividend payout ratios stood at 57.5% in FY25 versus 12% in FY22. And even in their Q3, you did see the company announce an interim dividend as well. So their dividend payout does remain strong. But, Hiral, before I go to the consensus ratings, how does the shareholding pattern look like?
So again, shareholding pattern is absolutely interesting, Mika, because if you see in terms of the promoter shareholding, no major change with regards to September to December period from the promoter standpoint. In fact, you have the FIs and the DIIs who've gone ahead and increased their stake marginally with regards to the company. So there is that FI, DI driven interest that's coming in terms of Gulf Oil Lubricant. And basis that, just because a marginal reduction that's happening from a promoter perspective, we've given it a neutral rating.
Got it. But if you do look at the 1-year picture, back in December 2023, the promoter shareholding was around 72%, if I'm not wrong. So from a longer term picture, it has come down.
Yeah, and one more thing that we need to consider over here, Mika, is in terms of the absolute number of shares also, right? Because the moment the equity base increases with ESOPs, etc., optically, it's seeming stable. So I think a neutral would be a fair one.
That's right. And lastly, you look at your consensus ratings and targets. You have this stock being actively tracked by 3 brokerages, all recommending a buy. And the average 12-month target after the correction we've seen this year stands at 1,720, which implies a return upside of 53%. But we're still giving the consensus ratings and targets a neutral because the number of analysts or brokerages that are tracking the counter does remain low relatively when you look at other companies, which is only at 3. So it's a neutral on this one, and we'll have to see. So, Hiral, what does the final scorecard tell us?
So I think if you have to look at the final scorecard, Mika, from the balance sheet to the P&L, return ratios, the credentials, their dividend policy and their cash flow, and the street coverage, I think a 6 on 8 would be a fair rating with regards to where Gulf Oil Lubricant goes. And this is taking into consideration that the business prospects have been absolutely steady, right? And the return potential for an investor, even if it's 3 analysts, is nearly 53% right now from the current market price.
Let's go on to the SWOT analysis. We're going to look at the strengths, the weaknesses, opportunities, and threats that do refer to the company. One is strong growth, and this is in terms of their volumes. Their volumes have always remained 2 to 3 times the industry average. This is in regards to 2022, 2024, as well as 2019 to 2022. They also have strong brand equity in terms of their recognition. They do have a global parent as well, but they also have a wide distribution network. This is on a pan-India level in their B2C as well as B2B markets, and they also have some exposure, around 5% to export markets as well, and they do export to around 20 to 25 countries. And lastly, the AdBlue category, which is a significant growth area of the company. It's a premium segment. They have 25% market share, and it's one of the top 3 in this category. In terms of, on the flip, on the other side, there's the weakness. One is the lubricant industry is a highly competitive industry. Second of all, they are the input costs that go into making lubricants and all the raw materials, especially oil, is one with fluctuating prices, and you've seen the oil market being very volatile, so it can have an impact on the company's margins. And lastly, the growth dependent, while they have diversified, it is dependent on the auto industry, whether it's your diesel petrol cars or your EV cars. It's on how the growth trajectory of the auto segment goes. But Hiral, in terms of opportunities, what lies for Gulf Oil?
Right. Let's quickly look at few of them. Now, firstly, if you talk about the opportunities, one is in terms of the government focus on infrastructure, right? So if you see in terms of that part of the business, there is increasing vehicle ownership and there is expansion that's happening in the auto sector. What this means is, in fact, the company themselves, if I'm not mistaken, had predicted that they're forecasting almost 428 million vehicles that could be ICE vehicles by FY28. And this is almost a CAGR growth of over 8% that could be coming in between FY24 to FY28. So that's the opportunity that they're sitting on with regards to growth. Secondly, the government focus with regards to where infra development goes and manufacturing boost. So this is what will help their industrial segment as well. And the rise of EVs is creating a new market for which, in fact, the company has already, made investments with regards to Tyrex, where they have 51% market share. And they have almost a 7.5% market share in terms of Indra Renewables. So there is great focus there where they're expecting total revenues of nearly around 600 to 700 odd crores over the next 4 to 5 years. So great opportunity coming in the space which they were not prevalent in, which is EVs. And very lastly, if you see in terms of the threats, now any economic downturn that could impact the industrial activity and the vehicle sales, so that's one of the biggest concerns that they're sitting on, that could be a threat. The environmental regulation, so AdBlue is a sector which is compliant with BS, I think 6 vehicles, and that's what is becoming an opportunity, but any regulatory changes that would come in from the government could become a threat. And any emergence of new technologies which they're trying to cover up with their investments in the EV space. So these are few of the threats you should be looking at, but a lot of opportunities as well. In fact, we did speak to the management itself, Manish Gangwal, who's the CFO at Gulf Oil Lubricants. And here's what he had to say about the company's growth prospects going ahead. Let's quickly listen into a chunk of that conversation.
Gulf Oil is one of the top 3 private sector companies in terms of lubricant in India. And we have a track record of growing 2 to 3 years the market growth in terms of volume. And that has been maintained over the last 15 years. If you go back from 2007, 2008 onwards, market is growing, lubricant market in India grows 3 to 4%. Because of the advanced lubricants coming in and high, long drain products coming in. And we have been able to successfully deliver close to 2 to 3 years volume growth of the market, and have been getting market share because of that, and nearly double-digit volume growth over the last many years. With that, the revenue growth is even higher. And obviously, with the size and scale and our product mix improving, we have been able to also deliver a profitable growth over many years, especially in the last 3 years. If you see, as you rightly mentioned, we have grown much ahead of the industry, not only grown and profitable growth, also our profit CAGR is also about 20% in the last 3 years. So yeah, overall a fantastic journey so far. And going ahead also, we continue to look forward to getting market share. by growing 2 to 3x the market. Now that we have a high base, we still have lots of pockets of growth opportunities for us. And we see that our brand is a very, very strong brand now. Is in the top two most recalled brand in terms of top of mind and consideration, brand consideration.
Right.
And we believe that on the back of this brand strength, we can continue to gain market share and satisfy Indian customers with high quality lubricants.
So Manish, my key question is, if you see in terms of volume growth, the company has maintained it at almost 2 to 3 times industry's volume growth, right? But the clear push that comes in over here from an investment perspective is that the global push that we are seeing for decarbonization. Taking that into consideration, how big an impact are you seeing with regards to EV? What is your expectation in terms of EV penetration? And do you see that supporting the lubricant demand going ahead then?
So we have done our studies, and there are global experts in the areas of lubricants like Klein. They have also come out with their study on Indian market and global markets. They come out and with their annual paper, and everybody seemed to be convinced and suggesting that the lubricant market will continue to grow in India, especially with the same rate of 3 to 4% over the next decade and beyond. In spite of decarbonization efforts, in spite of EVs coming in certain pockets of the vehicle areas like two-wheelers, a part of it will get converted, buses may get partly converted. And in spite of that, the lubricant market in India will continue to grow 3 to 4%. And with that, our trajectory and our target of growing 2 to 3x of that, which means again 7 to 10% volume growth, remains intact, and we are quite confident on that.
Okay. And what about the margin profile? Because, 12 to 14% is the kind of range that you've guided for so far. But from here on, taking the premiumization strategy into consideration, I think you've mentioned earlier as well that your product mix will remain absolutely consistent with 40% coming in from automotive, 25% for industrial, 20% from personal mobility, and the remaining from the other sectors that you cater to. How are you seeing that trajectory move in terms of where margins are concerned? I mean, to move from a 12 to 14% bracket to a 14 to 16% bracket by FY28, what is that strategy going to be?
So yeah, you're very clear in terms of we are internally very geared up to push our premium products more and more. Our product mix currently, as you rightly mentioned, 40% diesel engine oils and 22% personal mobility. And we have scope across all the categories in terms of pushing within the categories the premium and synthetic products. For example, in diesel engine oil or in motorcycle or in car oils, we have a very, very strong synthetic portfolio, which is linked to our global product portfolios. And we are bringing those products and high-end products into India market to our customers. And within B2B also, there is a clear focus on growing the premium side of the products and premium where we have better margins, high margins. So yes, over a period of every 2-3 years, we want to move to the new higher band of margin of EBITDA. Currently, we operate in 12 to 14% margin band at EBITDA level. And with these efforts and with the effort of product mix improvement and premiumization, we want to move to the higher trajectory of 14 to 16%. Also, with the increase in volumes, because we continue to grow towards the market, operating leverage also will keep coming in. And with that also, that will help at EBITDA level, because your fixed cost will not increase from here on in the same line as volume growth. And that's where operating leverage will also come in. And with both combination of that, we should be moving towards 14 to 16% band.
So Manish, I'll come in over here is because, everything said and done, in the end, it's about also realizations, right? Now, when we look at the blended realizations, there is some bit of muted moves coming in there, and that's obviously because AdBlue realizations are on the lower end. Now, AdBlue, overall, the segment is growing quickly. That is a low realization product. And this is despite the improvement in the core lubricant realizations, right? So how does that math fit in? Because AdBlue to my read, is going to be an important part of your business, taking into consideration the move that we are seeing towards EV?
So AdBlue as a category, as you know, is required in the BS6 diesel vehicles and across all categories of BS6 diesel vehicles. And the growth of BS6, ever since the BS6 was mandated into India, the growth of AdBlue has been quite phenomenal over the last 3 years. From here on, what we are seeing is that with the BS6 vehicles growing in a certain pace now, the AdBlue growth also will not be as astronomical as it was in the last 2 years, where we have grown in some years 70-80% and even more. So from here on, we believe that the AdBlue growth will be around 10 to 15%, and our lubricant growth will continue to be in the range of around 7 to 10%. And the blended impact on the EBITDA will not be that high as we have seen in the last 2 years. So from here on, again, lubricant will lead the margin enhancement with good profit pool coming from AdBlue, because AdBlue as a category, as you mentioned, is a low margin, low realization, but it helps us gain the overall profit pool.
Right. Manish, with all of this said and done, you've not left EV unattended, right? Gulf Oil Lubricants has aggressively expanded into the EV system through the strategic investments, I think, that you've made with regards to Tyrex and Indra Renewables, two companies. What is that trajectory looking like? Because last to what I remember, the aim was to double the revenue, targeting almost 50 odd crores in FY25 and around 600 to 700 odd crores in the next 4 to 5 years, with export opportunities coming in. So what is the view with regards to EV? How much will this segment contribute to your overall business, and how will it impact your margins then?
So yes, I think at the board level, at the group level, it was a very conscious call that EV will come in certain segments in certain proportion. And as a Gulf brand, which is a very well-known brand in automotive consumers' mind, we should remain relevant to the EV consumers or EV automotive buyers as well. And with that, our journey started in terms of investing in companies which are making chargers, EV chargers. And we invested in, as you mentioned, Indra, and that's a UK company making AC slow chargers, and Tyrex, which is primarily a DC fast charger manufacturing company. In Tyrex, we have 51% stake, and we consolidate our results in Tyrex. We have seen that there is a clear growth path which Tyrex we are aiming at. Last year, as you mentioned, we did 25 crore in FY24. This year, definitely we want to more than double. And every year for the next few years, the turnover will be very, the increase will be significant in terms of, nearly trying to double the turnover every year for the next few years. And from there on, we aim that in next 3 to 4 years, 5 years max, we should be aiming at Tyrex delivering close to 500 crore plus turnover on its own. And that will lead to an overall turnover at console level growing even faster than our standalone numbers. And the margin profile of Tyrex also is looking to be similar to the lubricant margin, and that should also on top add to the console EBITDA and consolidated numbers. So quite hopeful on charging business going forward, because India is still going for electrification in certain segments.
So Manish, to come in over here, 51% stake is what you have in Tyrex. Is there a possibility or a plan to increase it further? Because any which ways you're majority stakeholders in Tyrex, right? And with regards to Indra Renewables, I think 7.5% stake is what you have. So any plans to increase stake on that front as well? What is the strategy there? Because we are running slightly short of time, so quickly on that one. And two, if additional stake acquisition is on the cards over time, how do you plan to fund the same? Because you're on your free cash flow, you're still on double digits.
Yeah, so we continue to remain net cash positive at the standalone level. And we have all the clauses in terms of, right of first refusal in terms of Tyrex. So the board will definitely take suitable call at the right time in terms of increasing the stake further. And since we are quite bullish on the business model of Tyrex. In Indra, we have already 7.5%, and globally, Gulf International, our parent company, has majority. So the increase in stakes there will be a global call, not from India balance sheet. So obviously, we are at this stage looking and evaluating all aspects of it, not only at our Gulf Oil level, also at our parent level and at group level, at Hinduja Group level.
Right, so that was the management of Gulf Oil Lubricants, clearly highlighting the fact as to what's in store from here on, the rating that NDTV Profit has already given it. And if you see the stock performance in the last 6 months, it's down a little over 20%. So there is underperformance, but a 53% upside that 3 analysts tracking it are giving it. But completely out of time, but it's a wrap on this edition of Know Your Company. Stay tuned for lots more.